Hello everyone, and welcome back to our Futures Options Spreads lessons. I'm Joe Follico, Principal Futures Broker at Insignia Futures and Options. This video is the third lesson in the series, so stay with me. If you missed the first two lessons, I'll place links to both videos in the description below. Okay, let's get started. Here's another spread I utilize quite often, the calendar spread. The calendar spread is a credit spread. A credit spread simply means you are collecting a net premium when placing this type of futures option spread. With the calendar spread, we are selling an out-of-the-money futures option in a farther out month, and then we're buying that same strike price in a closer month. For this example, I'll be using the euro currency futures market. As you can see in this daily chart, the euro has been trending downwards for several months. Based on my technical and fundamental analysis, I feel the euro will not shoot up over 1100 points. I decide to sell the 110 calls in the March contract and buy the 110 calls in the January contract to set up the spread. I'll collect 40 points or $500 for the March calls, and I'll pay 16 points or $200 for the January calls, giving me a premium credit of 24 points or $300. This will be the maximum gross profit on this trade. 1 point in the euro futures equals $12.50. Remember to account for trade commissions and fees when calculating your profits and losses. In using a futures options calendar spread, we are gaining the following benefits as opposed to just selling a single option outright. 1. Longer staying power. If euro futures were to have a large jump in price, my long January calls would be rising in value to help offset some of the losses on the short March calls, giving me time to reevaluate the trade. 2. Lower margin requirements. By trading a spread, we could benefit from lower margin requirements as opposed to selling an option outright. The margin difference is almost 30% lower for the futures option spread in this example. 3. Effective in volatile market conditions. A market like the euro currency can be very volatile, up big one day, down big the next. By utilizing a spread, we are attempting to calm the volatility by being both long and short, again giving us longer staying power to ride out the volatility. Of course, we do have some downsides to the calendar spread. Because this is a spread, we typically have to hold the trade longer to realize a profit. We will also have higher trade commissions and fees as we're trading multiple contract months instead of just 1 month. Another point to keep in mind that can be a negative aspect is that the futures option purchased, in this case the January 110 calls, will expire 2 months prior to the March option sold, leaving you naked the short side. My personal feeling on this is that once I'm that far into the trade, I'll have a pretty good feeling if it's going to go my way or not. So by the time the purchased option expires, I'll know if I'm going to hold on or get out. As always, no futures option strategy is guaranteed to produce profits. This strategy can result in a loss. It's important to determine both the profit and loss you are willing to accept for every trade you enter before you enter the trade. I hope you found this futures option information valuable. I know options trading can be a bit confusing, especially when we start introducing spreads. If you have any questions about this strategy, please leave them in the comments below or feel free to contact me directly. I'll be happy to help.